Hey gang, it's Dave Littlejohn back again for another session of the stuff about money they don't teach in school. And today we're going to talk about taxes. Probably one of the most misunderstood things in the financial system, taxes. It's something that gets talked about a lot. It's something that we all get affected by. And it's frustrating, but nevertheless, it's something that we should pay attention to. So we're going to talk a little bit about the basics of what is happening and how it works. And maybe this will help you understand a little bit better so that when somebody says, oh, we're going to raise taxes or we're going to do this or we're going to do that, it makes sense. So let's get into it. I'm going to share a screen here, so stand by while I get that going. I need to do, I think, this and share a screen here. Sorry, working software behind the scenes, right? And boom. So here we go. Now I am drawing on the screen is actually over here for me. So if you see me looking this way, it's because I'm drawing over there. But let's talk a little bit about taxes. There are two primary kinds of taxes today. And remember, you guys can tease all you want about this. I'm drawing with a mouse. But if we're talking about taxes, we're going to talk about either number one, income taxes. Okay, so this is fun to draw out. Said nobody, right? So income, and then the other one is a different type, and we need to understand the difference between the two, because one of them is what we call a capital gain, and I'll just sort of abbreviate it because, frankly, it just takes too long to write it all out this longhand way, but a capital gain or income tax. So what are these? Okay, first of all, capital gains are, we're going to cover those separate than income. Income's pretty easy, right? If we go to work, then we earn a paycheck and we get income. And maybe you're self-employed. You still have income. It's the earned revenue that you get. And so here's what happens. Depending on where you live, not every state is the same. I live in Oregon. Okay, Oregon has a state income tax, but there is also a federal income tax. So what I want to do is, let me see if I can add, I'm going to hop around to number 4 here. I'm jumping around a little bit. Let's talk about the way income works. So, you have let's say you earn a chunk of money in the year, okay? And what'll happen is, depending on how big a chunk this is, okay, so let's say that this up here is $1 million. So we'll make this a big number up top. But let's say you're down here and you earn less than $1 million, okay? Then the amount that you earn down here is going to be subject to a certain amount of tax. But if you earned a higher amount, let's just choose a different color. Let's say you earned up here, then you would end up paying a higher tax here, and then if you earned even more than that, it could be even higher up here. Again, I realize the drawings are not that. I wonder if I can undo just that. You can. Look at that. So here, what we have is this graduated tax scale, and what it means is for the first amount of money that you earn, you actually may pay nothing for a certain amount of money, and then once you make more than a certain amount, you pay this much percentage of tax. And if you earn more than that, you're going to pay more taxes. And if you earn even more, you're going to pay here. And then as you get higher and higher, the tax scale goes up. So it's like climbing stairs. So it looks like this, okay? This is for the year 2020. And you can see down here, our source is the IRS. So I'm not trying to make this up. But there's different ways that we measure. So you can see here, if it's just you and you're single, we're going to have one way to calculate. If you are married, filing together, that's going to be different. And notice here, head of household or married filing separately. Married filing separately looks a lot like single, doesn't it? Right? If you look at these rates, they look pretty much the same. And that's because they are. You're not being taxed as if you're a unit. When you get married, you're being taxed as separates again, so individual pieces. That's a really important concept. We're not going to explore it a lot today, but I would tell everybody, one of the things to understand about when you get married is people think of it like, oh, married, we're in love, this, that, and the other, and that's great. But marriage is also a contract that then legally binds people together. and gives them different ways to interact with each other legally. All right, so when you're married, for example, you can give stuff back and forth to each other, and it doesn't count as giving it to somebody else. So there's no handoff if you're married. That's why if you die, your spouse can have all of your stuff, and they don't have to pay taxes or anything on it. They just get it. So that's part of the marriage contract. So it does matter, but let's not labor that point too much today. If we look at this tax rate, and I'm going to sort of jump back and forth a little bit here. I drew here, I don't know if I can move the position on the board. So I'm still learning how to use Jamboard here. It's a Google thing. But see this? If we hop back and forth, the first tier was 10%, and then 12%, and then 22 and 24 and so forth. So what it would mean is for the first amount of money that you earn, this would be 12%, or what do we say, 10%, and then 12%, and then we said 22 and 24 and so on and so forth. So again, income taxes, there's something else that we didn't talk about initially, and that is that there's a free amount of money that everybody gets that you don't pay taxes on at a federal level. So there's a standard exemption amount, and I'm just going to take this green dollar here, and what it is it's an amount. That did not draw well. Let's say though that we have this much money up here that is exempt. A standard deduction is the amount that anybody can take, because when it comes to taxes, it's not necessarily how much you make, it's how much after all of the special exemptions you have to pay taxes on, right? So everybody is eligible for what we would call, and I'm going to abbreviate it here, but a standard deduction per person. And so this year, I believe the standard deduction is like $12,500, okay? Or maybe 12,400, but close enough. You know, this is about a concept. It's not about having the numbers be specific, because they'll change, right? Over the years, the numbers change here and there. I want you to think about the concept of income taxes. So the concept is that at first, if you made only $10,000 in a year, but you had a standard deduction of $12,500, you take the $12,000 away from what you earned, and there's nothing left to tax, because if you made $12,500 and you had a $12,500 exemption, you show zero for taxes. If you had $100,000 of income and then you had a $12,500 exemption, then you're going to end up with what, $87,500? That's your taxable or your adjusted income. So when you hear people saying, well, I need more deductions, okay, there are lots of things that the IRS says you can deduct. Now, if your deductions are less than $12,500, don't bother. Don't like who cares if, well, I put in money to a retirement plan, that's a deduction, or I paid interest on a mortgage, that's a deduction. If all of the deductions that I have add up to less than $12,500, then we would take the $12,500 because it's bigger, right? And this is not tax advice. This is just like, well, duh, get the biggest tax break. And I say tax, it's not tax advice, because remember, I'm a financial pro. I'm not allowed to give you advice on the internet, right? If you want advice, you're supposed to call your person directly. So this is just how it works. We're not saying how to do it. I'm just saying here's how it works. When you have standard deductions, or if all of your deductions are higher than your standard deduction, that's called itemizing. And that just means, well, I'm going to list out all the items, and I'm going to add them up, and then I'll deduct that from my income, and what's left is what I pay taxes on. So here you have the standard deduction, and it comes out of here, and you can see the standard deduction will, in effect, shift my tax curve down by this amount, right? That's what's going to happen. It'll shift the tax curve down. The other thing that people mistakenly think about their taxes, and again, let's just go back and look at this, is they say, oh, okay, look, I've got... If I earn between $85,000 and $163,000 after I take my deductions, right? So if this is what I have after all of my itemized or my standard deductions, then I have to pay 24% tax. And that's not true. You pay 24% tax on everything in this range, Okay, but for the 85, the block of money from 80, this block here, let's use a different color. Let's use blue. This block here, you pay 22%, right? So you only pay 24% on everything above 85,525. And so if we were to do the math, what you'd see is, okay, well, 24% of, let's say we earned $100,000 after deductions. 24% of our $100,000 would only be, you're only spending about $15,000 at 24%. And then here you've got between 40 and 85. What is that? That's about $45,000 or so, a little more than 45,000 at 22%. And then you've got a big chunk here, another $30,000 of it, and we'll use, again, a different color here. This group is taxed at this lower amount, and so what you end up with is an average of all of these. So your blended tax rate isn't the highest tax rate you pay, nor is it the lowest. It's the average weighted for all of these put together. That's your total tax burden. So if you had some of your money was 10%, some of it was 0, some of it's 12, some of it's 22, and some of it's 24. When you smash it all together, you may have an average of 17 or 18% total tax, right? Now, here's where other people misunderstand. So I'll go jump back to this other page for a second. When we talk about our blended tax rate, right? So we have, let's say our average, here was our average, our total income was here, and our average tax bracket means we had some in each of these categories. So our average tax falls somewhere in here as a percentage. Maybe our tax is 18% on average. Well, that's for all of the dollars in our pot, right? So all of our dollars average out to 18%. But let's say that we earn an extra $5,000. Well, the extra $5,000, every dollar is taxed at the highest amount because all of these other dollars were the lower. So now we're adding more into this bucket. And what are we doing? We're tilting the average, right? We're making this average number go higher because we're putting more money into the higher tax category. And again, this is a misunderstanding too. There's a concept called retroactive, meaning, well, if I earn this much money, I only pay this much tax. But as soon as I earn this much, all of the money gets taxed at this higher rate. That is not how our system works. We have a blended or a graduated tax rate. So as people earn more, the tax rate does go up, but it doesn't make every, if I go from $100,000 to $101,000, I go from being in 22% to 24%. So that I earned $1 more and I had to pay an extra $2,000 in taxes. It doesn't work that way because it doesn't make all of the earlier dollars cost. It doesn't increase the tax on all the other dollars. It's just the additional dollars where the taxes are higher. So hopefully that makes sense to everybody. Now, this is the income tax thing. This is what people all day long talk about. That's what they think about with taxes. But there are lots of other taxes, right? I mean, if you have a cell phone bill, look at your bill. It's not like, well, here's how much the service costs. There's 911 service fee and universal access charge, and there's this and that and the other. So lots of other little ticky-tack taxes get thrown in all over the place. You don't honestly think when you buy a gallon of gas, you're just buying the gasoline, right? I mean, there's a tax on all of that as well. One of the things, and we don't have this in Oregon, so we don't think about it a lot, but there's such a thing as a sales tax, right? And so a sales tax is a different concept to think about than income tax, right? Income tax is money that the more money you earn, the more you pay. Sales tax, you only pay it when you make a transaction. So think of it like a transaction tax. If you buy something, then you pay a percentage. And again, if you're not from Oregon, you're like, that's weird. But everywhere else in the country, pretty much, except for like Delaware or something, they are used to paying sales tax. So, here's the price of the item. And then when you go to pay for it, you have to pay this extra amount, and that's a sales tax. Sales tax is what we call a regressive tax. Okay, it's a fancy word, but what it means is, think about this. If you make $100 and you have to pay taxes and you buy something for $50 and maybe the tax is, let's say 5%, then you pay an extra $2.50 in taxes. If you earn $10,000 and you buy that same $50 item, you still pay the same $2.50 of tax, right? But to the person that only had $100, the $2.50 of tax is a lot of money compared to the $100 they have. So it hurts. They feel it more because they don't have very many dollars. If you have lots of dollars, if you have $10,000, the $2.50 is a much smaller amount of your $10,000 pot. So one of the things we talk about is regressive taxes. And what a regressive tax is, it's one that it's more expensive the less money. If you don't have a lot of money, it hurts more, right? A regressive tax, you feel it more. A progressive tax means that the more money you make, the more you get taxed. And that's why it's important to understand back here, this one here, this is a progressive tax code. You'll notice that it gets higher and higher the more money you make. That's progressive. Sales tax, some would argue it's not progressive, it's flat, it's the same, it's an equal tax, so everybody pays the same. But then some will say, well, no, proportionately, if you make less money, you feel a sales tax more. So they call it regressive in that respect. But now you understand the language because there's an ongoing debate about taxes. Are they progressive in nature? Are they regressive in nature? Or are they equal or flat in nature? And what does that mean? So let's go back to not the sales tax, right? We just talked about regressive, not the income tax, but the other tax that never gets talked about. This one, by the way, by personal opinion, is the one that gets most abused. Okay, because you've probably heard at some point, and I'm in the danger here a little bit, but you just need to understand the way it works. When people say rich people don't pay their fair share, well, most people are thinking about income tax, because if you think about a rich person, maybe you make like tons and tons of money, but maybe they don't actually make the money. Maybe they just own really valuable stuff, right? What if I own a building, right? Like I own a skyscraper in New York. And so it's worth a lot of money. It could be worth hundreds of millions of dollars in real estate value, but I can't like spend the building, right? So I have an asset, but it's not liquid. So it's really hard for me to spend. So I might be rich in terms of the value of what I own on paper, but maybe I'm not very liquid. So when people say things like, well, the rich people should pay their taxes. Well, I agree, everybody should pay their taxes. So I'm not making that. But I am suggesting not every person that's rich has lots and lots of income. They may own lots of assets. And so sometimes when people say, well, we need to figure out how to get them to pay their fair share, then you have to think, well, the money has to move, right? It has to be liquid in order to get access to it. Because otherwise, imagine if you owned a house and then you're supposed to pay property taxes. Well, what if you had to pay taxes every year like income? Like the more expensive the house, the higher the property tax goes. Actually, a lot of this kind of works that way. But if you don't have enough money, you don't pay the taxes, then you don't get to keep it, right? You're going to have to sell it in order to pay the taxes. And that's kind of the challenges. If you buy an asset, let's say you buy stocks in the stock market and you hold on to them. If the stock doesn't make any money, you're not paying property taxes on your stock. So how do you pay taxes if it's just sitting there, right? It might be going up in value, but if you haven't sold it, then we have to talk about the other kind of tax, right? And that is a capital gains tax. So if you buy something cheap and you sell it much more expensive, that's much higher. That is a profit, right? And the IRS wants to tax the profit, and we call that a capital gain. Capital because, that was the money we used as our capital that we bought something with. And then the gain is the appreciation that we made. So I bought something for $100 and I sold it for $200. That's profit. I need to pay taxes on the profit, not the amount that I started with necessarily. Like if I bought something for $100 and I'd already paid taxes on my $100 in my income, well, I already paid taxes on that, right? Remember the IRS says we get you on the way in or we get you on the way out. We learned that yesterday in the IRA class. So if you think about capital gains, well, I paid for money I already paid taxes on. So they already got me on the way in. How do they get me on the way out? On the profit. So they don't get to re-tax the money I already paid taxes on. Instead, they're going to tax me on the profits. Now, they divvy this up in two different ways. There is what we call long-term, and then we also have short-term capital gains. So long-term capital gains behave different than income. Okay? The reason I'm pointing out long-term here is because you know what a short-term capital gain is? If you're nodding your head saying it's just like income, you're right. If I buy something and sell it for a profit in the same year, here's maybe the way to think about it. Maybe you've heard about people that flip houses, right? And so they buy a house and they fix it up and then they sell it a few months later for a big profit. You know, they have all these like shows on home channels about this. Well, when you flip a house, what they've done is they bought it low, they put some money into it, and then they repaired it, and they sold it for the profit. But if they took less than 12 months to buy and sell that house, then that is a short-term profit for them. Less than 1 year is considered short-term. And if that happens, that's just considered income to them, and that's taxed, how did we say? Income. So they're going to be in the same, God, I made this all messy, right? But you get the idea is that the income at this point, I'm going to make this so you can read it again, heaven's sake. Income tax is going to be what they do for short-term capital gains. But long-term, that's a different story. Long-term capital gains, and why do we have a different rate? Well, at some point, the people writing the tax code said, we want to incentivize people to invest long-term. We don't want people just flipping things all the time. So let's give them a preferred tax benefit for long-term ownership. And what happens is, if this is how much income you make, right? And notice they're pretty similar for single versus married here, but it changes shortly. But if you make under $40,000 and you have a long-term capital gain, you don't have to pay taxes on it. Okay? If you have income in a larger category between, single filers go up to 441,000, and then interestingly enough, the married filers, there's kind of a penalty there, right? But 15% tax on what you will pay for capital gains. This, by the way, is a lot lower than here, right? I mean, think about it. From 40,000 to 85, not 22, not 24, not 32, but 15. So capital gains are lower tax rate. And then here, the highest capital gains rate is 20%. So you could buy an office building and sell it for $10 million of profit, and you could pay 20% tax on it. But if it had been income and you'd made big money, you'd have been paying 37%. And this is just federal. We're not even talking about state taxes potentially. So capital gains are a very preferred tax rate. And this is part of what folks don't often understand. And so I want to impress upon everybody. I know this class is a little long today, but think about the difference between how your money gets taxed. Is it income to you? And income is lots of things, right? If I buy a bond, it can pay me interest, and that's income to me. If I go to work at a job, I can get interest, or I get my employment income. If I buy a stock and it does a distribution of a dividend to me, that is income. If I own a rental property and people pay me rent, that is income. So lots of different forms of income that we pay taxes on. But the profit on buying something at a low price and selling it at a high price, if it's been held for longer than 1 year, is a lower tax rate. It's not considered income. It is a capital gain, and it has a preferred tax treatment. So that is the real key to today's call. And so when you talked about financial planners and strategy and being clever in the system, what are you trying to do? You're looking for ways to either get more deductions that lower your taxes. It's what we call tax exposure, right? The less money that you are exposed to pay taxes on, the lower your tax rate. Or the more that you can convert things from income to capital gains, the lower your tax rate. So, or if you can defer altogether, those are other techniques. And so these are planning techniques that you see used for tax management, but now you have a basic understanding of taxes. Okay, we know that they get you on the way in or the way out. If you're paying as you go, you have income taxes and capital gain taxes as your primary two types. There are other types of taxes, and there are other codings for how money works, but these are the big ones, right? Capital gains versus income, how that tax works. So hopefully today has been useful. Again, thank you for your patience. I know this was a longer call or a longer webinar, right? But in this circumstance, it's kind of complicated. So could we squeeze it down and make it like really short? I guess we could, but I think you would miss some of the important nuances. The reality is, if you go to work in this world, you will deal with taxes because you know that there are only two things in life that are certain, right? Death and taxes. So now you know about taxes. All right. Thank you for tuning in. As always, a reminder to all of the parents out there, we have additional resources. If you go to littlejohnfs.com, that's just our webpage. So you can find that. We'll try to put links down below in the video if you're watching on YouTube. Also, if you want to get more of this stuff and you want to be notified, be sure to click not only the like for the channel, but the subscribe bell, and that'll make sure that you are able to view these as we push them out. We're getting to the end of April here soon, and so we'll see how we continue to push this out during the COVID-19 shenanigans. Okay. Also, if you've got specific questions or topics, please send us an email or put them in the comments. info@littlejohnfs.com. And for everybody that's tuned in and joined, I sincerely appreciate you guys. Stay healthy and safe and sane, and take care of each other, all that good stuff. Until next time, this has been David Littlejohn. Thanks. We're signing off.